Hey everyone, Jeff Dorman back again for another edition of That's Our Two Satoshis Live, where we talk about everything happening in the digital assets market. Of course, this is not investment advice, but we do this every week and we talk about what's happening in the markets. We also write a blog accompanying this that you can find on our website, ar.ca/blog. So let's dive into it. No guest today. You just have me, unfortunately. A couple different sections we talked about this week, though, because there's a lot going on actually in the markets. First, of course, unfortunately, can't talk about anything happening in crypto right now without talking about the macro setup. We saw a third straight week of digital asset market momentum. A little bit different than what we've seen in the past, though. This time, both equities and gold participated as well, and actually treasuries were higher as well, meaning yields lower. We did see some dispersion, though, in the market, especially. Call the majors, Bitcoin, ETH, Sol, all roughly up 10%, but we saw much larger gains in the 20 to 50% range for things like AI and DeFi, some of the sectors that have been beaten up the most. But the real question is, we always talk about, is crypto correlated? Is it not correlated? I mean, the answer is it's not correlated. And the fact that we continue to bounce around so often with different short-term correlations is the definition of uncorrelated, because none of these correlations hold. But the question is, can we actually break away from equities? Can we actually break away from the macro? I'm not sure if it really matters, to be honest, because I think, look, this is a pretty binary market environment, right? It's either much ado about nothing as it pertains to the tariff-fueled sell-off in both equities and digital assets, because pretty much every problem that everyone is worried about can be unwound pretty easily without any real damage happening. In fact, if you look at actual economic data, things like jobs reports, manufacturing data, retail sales, corporate earnings, everything's been fine, right? There's been no actual impact yet from the tariffs. If you look at every forward-looking survey or expectation-based data report, things like inflation surveys, manufacturing surveys, consumer confidence surveys, et cetera, business spending, everything's a train wreck, right? Already, looking like we're headed towards an imminent recession. In fact, just to look at kind of the 180-degree turnaround, almost every Wall Street strategist was bullish to start the year, and now they're all incredibly bearish. Apollo, obviously not a Wall Street bank, but one of the biggest asset managers, probably the funniest of all of them. They famously put out a slide deck at the beginning of the year assigning a 0% probability of a recession, even though they also thought there would be a 90% chance of tariffs. And now, last week, they shared a 40-page slide deck indicating that we're already in a recession because of the tariffs. So, look, the Federal Reserve even published something last week that talked about the disconnect between what consumers actually do versus what they say. This is the tricky part of the market right now. Like I said, nothing bad has actually happened, but the expectations of bad things is driving price. So I wouldn't say we're 100% out of the woods, but I do think that either way, we're probably going higher in markets for a while. If you look back to 2008, for example, Bear Stearns imploded in March of 2008, and then nothing happened until about September of 2008 when Lehman Brothers ultimately went down, and you had Merrill forced sell to Bank of America, and tons of regional banks going under. So over that time period, from the bottom of March 2008 until about August of 2008, you actually had a pretty stiff rally in equities, almost all the way back to where we were pre-Bear Stearns going under. So my point is, even if we are headed towards a recession, we're not really going to get there for 6 to 12 months. And most people don't stay short for that long when you're clipping dividends and you're clipping coupon payments on your bonds. So good chance that shorts are going to continue to scramble either way. But I do think the ultimate outcome here of whether or not we really do slip into a recession or this ends up being much ado about nothing because all the tariffs are reversed and walked down, it's a pretty binary outcome. Specific to crypto, though, what I do think is probably more interesting in the market, and certainly more interesting than just talking about macro all the time, is you probably saw last week that the Trump team changed the tokenomics on their token, meaning when the Trump token was first released in middle of January, it was just labeled a meme coin. There was nothing to it, right? It didn't give you anything. The Trump team itself was keeping 80% of the supply. Only 20% was issued as float. And people just bought it because it had Trump's name on it. And, there's a cohort of investors, not ourselves, but a cohort of investors who care about meme coins and think it's fun. But as we always said with crypto is that, you can change what a token does at any time. And that's exactly what the Trump team did last week, announcing that the top 220 holders of the Trump coin will be invited to a dinner with the president on May 22nd. And the way they're doing it is that basically they're taking I believe, a weighted average snapshot of how much Trump token you own between now and May 12th. And that anybody who's in that top 220 list will get invited to this dinner. So immediately you just took a meme coin that had no value and you added some value to it, right? Clearly, there's no denying that there is some value to having a dinner with the president of the United States. So you cannot argue that this feature immediately makes the Trump token more valuable today than it was prior to the news. And the markets reflected that, right? Almost 100% rise in the Trump token. Now, it's very difficult to quantify what that's worth, but you can track wallets. There was something like 24 wallets that immediately bought more Trump token to get into that top 220 holder list on the news. So clearly, if at least one person values that dinner with the president, that's going to make the token higher. So what I think here is that, a ton of polarizing responses to this because everything Trump does is polarizing. A lot of people quick to point out that because Trump and his family and his business controls the coin and the majority of the tokens, that essentially this is an unethical pay-to-play scheme dressed up as a meme coin. Quick Google search there, you'll see 1,000 different articles talking about how this is, unethical. I don't care about that. Not that I don't care about ethics, but I don't really care about the Trump coin itself. What I care about is that this is, again, what we pointed out back in January when Trump first issued the token, that it was less important about the Trump token itself and more importantly, what it's doing in terms of setting precedent for a gold rush of new token launches, not just by politicians and celebrities, but soon by municipalities and companies and universities and all kinds of other entities who are eventually going to issue a token and recognize that you can change the terms of the token at any time. So we've always said that tokens are incredibly powerful instruments. They're the best capital formation and customer bootstrapping mechanism ever created. They instantly align all of your stakeholders. They turn your customers into power users and evangelists. More importantly, you can change the functionality of a token and it change the value driver at any time. Maybe a token just starts as a wrapper for some sort of type of asset. It's just like an equity-like token, or it's a loyalty rewards-like token, or a governance token. But as you add features along the way, you can start paying dividends. You can start doing buybacks. You can offer a dinner with the founding team, et cetera. This is one of the most exciting aspects about token investing, is that these tokenomics and use cases can morph throughout the lifespan of a token. Meaning you can't just lock in a singular opinion of a company or a project on day one of a token launch. You have to think about how that company or project can change over time and what that could mean for the token. And this is incredibly different than the fixed income market, for example, which typically locks you in on day one because there's covenants in the bond or the loan agreement that restricts what you can and can't do. Equities maybe give you a little more flexibility in the form of, will they issue a dividend or not? Will they do a buyback or not? But they're still much more limited in terms of what it can offer. But tokens can offer you anyway, right? Again, we always talk about tokens have value because there's financial value, there's utility value, and there's social value. The ability to add any of those three features at any time is pretty powerful. And, critics would say that this is both positive and negative because, you could just as easily, do something negative to the tokenomics, but that never happens because almost all of these changes end up being positive because, again, the stakeholders are aligned. If the founding team, the employees, the developers, the customers, the passive investors all own the same instrument, there's no reason why they would ever do anything detrimental to the instrument that everyone owns. This is why almost every action in the token market is always token friendly. So, this is something that I think most investors miss, right? They're so focused on meme coins and so focused on Bitcoin that they don't understand that tokens are a better investment instrument than anything we've seen before for all the reasons I just mentioned. So if you go back to what we wrote last week, on our blog, we talked about how the Gensler-led SEC killed token creativity, right? They scared token issuers from doing anything that was valuable by the threat of jail or major fines. Now that seems to be loosening, the Trump token itself is giving us further evidence that the Gensler era is over and more companies are going to start doing token holder friendly announcements without fear of government retribution. So we think this is a massive positive. We just continue to find more reasons to move away from the last 3 years, right? Long gone are these VC-funded, high inflation, low float token launches that go straight to zero. And yes, I'm looking your way, Coinbase and Zora with another horrible token launch last week. Get rid of this crap that nobody wants, and let's start putting in the better token launches with better tokenomics and the ability to change them to the upside over time. So, I think as more and more investors start to realize that this shift is happening, you'll see more value investors come into this market. You'll see more activist investors. You'll see more event-driven investors. We'll get away from this sort of just, trade-happy macro fund, technical analysis-driven trading, and you'll actually get into real value investors. And by the way, that's why the best performing tokens last week were things like Hyperliquid and Radium and Maker and Jupiter and Aave. What do these have in common? They have good tokenomics. They're taking portions of the revenue and buying back tokens. That's where we should have been headed all along in this token investing world. And finally, we're heading in the right direction because of the changes at the SEC and the changes in the government. So obviously, you guys know how I feel on this. I'm all for it. I think we should be getting as creative as possible. Token launches. I'll make a direct call to all investment bankers out there, sitting there wondering when you can do another boring debt deal or equity deal, and realize that this is the future. Every company you cover, every project you cover, every local restaurant and local gym and local, bodega and every university and every municipality, they're all going to have tokens one day. Disney's going to have a token. Netflix is going to have a token. Harvard's going to have a token. You name it. And you guys as investment bankers should start pitching this idea to people because it is going to work. And as you issue a token and you add these features, you create more value. And that's why the Trump token is up over 100% on this news. So great job, in terms of the Trump team understanding how to increase the value. Again, don't really care about the Trump token so much, care about what others will do in response. And I think this is a great precedent going forward. So with that, I'm going to leave it here. I will say one other thing. Shout out again to Topher McPherson on our team, who wrote a great write-up last week talking about value capture, followed up this week talking about what Radium is doing. I don't want to ruin it and spoil it. Maybe we'll get Topher on the show next week to talk about it. But you should definitely look at the blog and read about what Radium is doing here, because this is one of the most high-volume DEXs in the Solana ecosystem. They used to get a lot of their revenue and volumes from Pump.Fund. Pump.Fund decided to go the other way and do it on their own. Meanwhile, Radium is now partnering with Bonk, who has just as many users as Pump.Fund. And it's a really interesting dynamic here because you've got two companies that are essentially doing the same thing with the same offering. But you've got one in Pump.Fund who basically takes all the money for themselves and gives it to a handful of their VCs and then just sells a bunch of Solana on the market and takes all the cash. And you've got the other with Radium and Bonk who actually stay crypto native and take their money and pour it back into the market and do buybacks and try to reward their token holders. So again, it's just a really interesting dynamic. We've talked about this in the past before with things like Uniswap versus Coinbase, where you have like two businesses that are essentially the same, but one of them has no token and only has equity, and the other one does have a token, and how these different dynamics come into play. Same thing happening right now with Radium and Bonk versus Pump.Fund. You've got one that completely just extracts from the market in Pump.Fund. There's no real reason why anybody should use that product. And the other who gives it all back to the community and gives it all back to their token holders. Not to mention for Radium, it's all upside, right? They're basically just taking additional revenue from what Pump.Fund used to take without really affecting their core business at all. And, we modeled out some annual revenue there. You could be looking at, close to $1 billion in revenue run rate if Radium continues along this path of taking some of these token launch bonding curve fees that Pump.Fund was getting before. So really interesting analysis by Topher. I encourage you to check it out. Maybe we'll do another one on Hyperliquid next week. But bottom line is, this is the stuff that we can talk about again, because again, for the last 3 years, all we could talk about was meme coins and Bitcoin because everybody was so scared. We're not scared anymore. Let's have revenue producing companies and cash flow producing companies and take that money and pour it into the tokenomics and find interesting utility, like setting up a dinner with the founding team. There's all kinds of things you can do to create value for tokens. This is what excited me 7-8 years ago when we first started ARCA, getting involved, and it still excites me today. And I'm glad that we're finally starting to see some of this, and investors are being rewarded as such. So pretty good week in the market last week. As I said, most things up 10%, some other sectors up 10 to 20. Month to date, you've got certain parts of the market like AI and DeFi up in the 50 to 100% range. And again, it's exciting to see that most of the gains are coming from well thought out tokens with real good tokenomics, right? We're no longer just in that if you build it, they will come mode. You actually have to create value. And that's a great thing for value investors like ourselves. So check out the blog on our website, ar.ca. We'll be back again next week. Thanks, everybody. Talk soon.